All right, guys, let's look at chapter 11. So this talks about stocks instead of bonds. We looked at bonds already, but this actually goes over the stock financing. So it's going to be kind of similar in how we'd have with like par value and premiums and discounts, except the difference here is that we don't ever give it back. And so this can be advantageous, but difference is that there's voting rights attached to the stock. So we've talked about some corporate formation before. It's an entity, it's its own separate company. Um, they can be privately or publicly held. Advantages: it's its own separate company. It can have limited liability, transfer, continuous life. This is all kind of refresher here. Um, the big disadvantages that we've talked about before is the government regulation and the corporate taxation. This is for those for C corporations. Um, Usual normal corporate organization and management. You have your employees at the bottom, stockholders is who everybody's reporting to, board of directors, and your other officers here. A lot of these in a privately held business are all the same people, so kind of keep that in mind too. Um, if you own three shares in a publicly traded company, you'll get a meeting or an invitation to a stockholders meeting. You can either vote by proxy. You can mail in your vote for any items that they have going. Um, some people just buy them to hold them periodically and then sell if the stock price goes up. You can hold for dividends if that's what your main focus is. Okay. Um, just basic capital stock here. If we have a par value, it's kind of be just like our bonds. We're going to have a listed price. Sometimes we don't know what that's going to be, so we'll say it's no par value or stated. It just says that's the same as the assigned value as par value. So we'll have some different calculations to go into when we actually do this. So if it's just like with our premium, is if we sell it at higher than our price, we'll have some additional paid in capital if it's higher than our par value. So once we have kind of declared what the par value stock is, that's going to be in the organizational structure. Or if we have an initial public offering for our stock, that's going to be what our par value stock is. All right, go through here again. All right, so it says that we issue 30,000 shares of $10 par value stock for 30,000. So that's just like we've done every transaction before, where the owner contributes money and gets stock. So in this case, it's just like we did the par value for bonds, cash, and then common stock. In this case, once we have $10 par, the market may have determined that the shares have actually gone up in value. So we get to issue at the market price. People are going to pay $12 per share for this stock from us. We don't have to give this back. That's the difference in the bond premium and the stock premiums. We don't have to ever give this back. This is our money. Our stock was worth $12 when we issued them, so this is our money now. All right, so we have the cash, it's common stock, and we show this as additional paid in capital or paid in excess of par value for common stock. There's no amortization that goes into this. There's no, we don't have to bring this back in alignment. That's just how much money we got when we sold it. All right. So this is what our balance sheet would look like. We would have common stock at par value. We have additional or paid in excess, paid in capital, and then we'd have retained earnings if we had, income for the year. If there's no par value, that's what we issue them for that year. All right. Stated value it's just like par value. If it says it's $40 stated and then we sell them for $50, then we're going to have some paid in excess for stated value. All right. If this is for land instead of cash, then we'll have to say the land is valued at 105. You just would have to calculate out here that it's $80,000. So we'd have some paid in excess. It's just a non-cash asset transaction. Same thing for this is very common for organization at the beginning of the company when you have somebody doing the work for it, and we might have a fee swap type situation. You have organization expenses instead of cash. They're so especially if maybe one of the partners or one of the owners is a lawyer, something actually doing the work for us to set this up, then we would give them stock back for their work, and we would value that for how many shares they're going to get, and then go in and say this is what their value was, paid in excess, and then book the organization expenses. All right. All right. I've mentioned this in passing before, but to pay a dividend, you have to have retained earnings and you have to have the cash. So you can't pay retained earnings without income and sufficient income to pay what was supposed to be there. All right. So we record the liability for the dividend on the date of declaration. The date of record, it's just when we record it. And then the date of payment, we actually record the payment, the cash payment to the stockholders. All right. So on January the 9th, we record a $1 per share cash dividend. On its $5,000 shares, we record the $5,000 retained earnings, reduce our retained earnings, and book the payable. All right, it's going to be paid on February 1st. Recorded on that date, that's fine. Nothing happens then. All right, and then we actually record the cash payment on February the 1st. All right. Stock dividend is you just give the stock out instead of cash. It actually gives us a benefit of using the value of our stock at times instead of actually having to pay cash. All right. So if we have retained earnings here, all right, we get to use the par value and paid in excess. So we've taken our value of the stock and using it to go forward because we have stock we can issue. Okay. Go through here again. All right. Nothing different there. Nothing different there. Stock split. All right. A stock split. This happens a lot of times when the stock value gets to be too valuable. Okay. Or gets to be too expensive, and it kind of inhibits people's ability to buy our shares on the market, that we will split the number of shares that we have to lower their value. This has happened several times. Amazon's done this several times, IBM, to create more shares in the market, but the value is less, and all that's all we're going to do. We're just going to split the number of shares. The total number of the total value in the market is the same. All right. So nothing changes, okay? Nothing changes in a stock split. See this? Nothing changes on our stockholders' equity. There's no adjustment. All you're going to have to do is when we do this on our homework, all we have to do is actually go through and say that instead of having, 100,000 shares at $20 par, we would have 200,000 shares at $10 par on our on our statement of retained earnings. Preferred stock, okay. It doesn't have any control in preferred stock. Okay, that's the difference in that. You don't have any voting rights in preferred stock. Um, these have more dividend payments. All right, but there is no control, and a lot of times they have preferential treatment for dividends. All right, treasury stock. Treasury is where we buy our shares back. That's where we are buying our shares out of the market. Okay, and then we can then use our shares. Okay, to do other things with it. Okay. The calculation quirk to this is if it was originally a $10 stock and it goes all the way through the market through numerous hands and I buy it back at $15, that becomes my new par value. Okay, it doesn't matter what I originally issued it for. It's when I buy it back that becomes my starting point. Because then I can sell it again. All right. So that becomes my new par. When I put it on my books at treasury stock value, it's what I've paid for. We call it in the tax world, we call it our basis. That's what our basis is. Okay. So I buy a thousand in the open market at $11.50 per share. I don't care what the par value was when I originally issued it. It could have been $1 a share. I'm paying $11.50 per share because it's been through a washing machine of however many owners between when I originally issued it and when I'm buying it back. All right. If I sell it now, I could have a gain or loss when I sell it, and I'm going to have to account for that with additional paid in capital. Okay. All right. There's my gain or loss. When I'm selling these right here, selling an additional share, I'm going to have my paid in capital on treasury stock. So I sold it for 12. All right. But my cost was 11.50. So I have this additional paid in capital. I actually gained money when I sold it by 50 cents a share. That's where my starting point becomes that 11.50. Anything over or above, I have to deal with then. Okay. You see, it could go in the reverse this way. If it went down 30 cents, I have a negative, all right, paid in capital on this calculation. All right. This is just a note here about retained earnings. A lot of times, the government regulation portion of about corporations, a lot of times you may have to have some restrictions about treasury stocks, and the biggest one is you have some contractual regulations about loan agreements may limit how much you can actually pay out in dividends. You have to maintain a certain amount of retained earnings, and if you don't, you could violate your loan agreements, which will then also violate your loan covenants and make all your loans due and payable. So we have to watch that at any time. Okay. Prior period adjustments, we try to avoid these, but there's sometimes it's not worth going back and restating, and we would just say anything that was reported, we'll just put it in the retained earnings because it's not something that affects. We talked about the matching. We don't want to go back and put it into this year's earnings because it didn't happen this year. We're just going to say that this is actually something that affected a prior year. So this is what our net income should actually be. Okay. These are these two ratios. Again, y'all will have these on your notes. Um, Earnings per share, basic earnings per share, net income minus the dividends, weighted average common share. It's weighted. All right, how many shares per day? It's not just an average. You have to weight it out when we do our calculations here on the homework. Market value, price per earnings, market value, price per share over the earnings per share, dividend yield. All right. All right. I will post a homework video as well. And then always you can email me with any more questions.